The only incentive that they have there is to capture the order flow and give people a fair or somewhat fair market. But as soon as more sellers start hitting the marketplace, the market makers will move their price down because they want people to sell at lower and lower prices. They may be moving price down because they know they have a block of buy orders down here that they need to fill, or they see that there's a big order, a big block or a big range of buy orders down here. But in either case, what you're seeing is an imbalance of buyers and sellers. When the market starts moving back up, you can see that now the pendulum is swung the other way. Now there are more buyers than sellers. But let's take a look at the difference here in the bars. Okay, let's zoom in and let's just take a common sense approach to this. You can see that as the market is moving down, these are fairly large bars. The bars, started off closing a little bit off the bottom, but eventually you can see that they were closing very near to the bottom, which means that the momentum was to the downside. Now look at what happens here when the market starts moving up into this very narrow flag pattern here. You can see that there's just not a lot of momentum. Okay, there aren't a lot of traders out there that are willing to buy or buy in a continuous fashion. Now let's take a look as the market starts to drop even further. So the market breaks through the low here. It breaks through the flag pattern. So we had two possible entries, here and here as the market is falling down. And you can see once again that momentum comes into the marketplace. But now look what happens when the market starts to bounce. Look at the difference. In fact, let's give a more exact comparison. You can see that the initial bounce here before the market really retraces is 71 pips. Now let's look at the difference over here. Once the market does bounce and retraces the first time over here, look at this, 38 pips. So roughly half of the distance. So the market moves down, bounces 38 pips before it retraces the first time. And in this case, the market moves down and bounces 71 pips before it retraces the first time. And we can see here that it actually retraced down to this lower line, nearly to this lower line here, before finally starting to move up. So there was a considerable difference in momentum. Okay, and again, we're talking about the logic behind the patterns. So the logic behind the patterns would dictate that, well, if the market is bouncing and it's forming this, this rough flag pattern here, if the market breaks to the upside, then what does that mean? Well, it's showing an increase in momentum to the upside. But if it breaks to the downside, either the flag pattern or breaks to the downside here on the bottom, that means that the momentum here is continuing. Okay? So there's a logic behind the pattern. The flag pattern starts to form as the buyers move into the marketplace. And it's simply demonstrating that the market now has more of an imbalance to the buy side. So if the market can break out of this pattern to the downside, then it must mean that all of these buyers now have been overwhelmed by more selling orders. If the market breaks to the upside, then it means that these buyers were joined by additional buyers to overwhelm the sellers here that had pushed the market down. Okay, so there's a logic behind the pattern. Also, when you see the market moving down and it stops at a certain price, okay, there was, for whatever reason, a limit to how low traders were willing to sell the pound down to. And the reason why we call this support is because traders were not willing to sell 1 point or 1 pip less. How do I know?